Picture this. You just had a tough month at work, slaving away flipping burgers at your local McDonald's. You go to bed and receive an email saying you were paid $2,000, but your bank account only gets $1,456. You scroll down the pay stub and see federal income tax, state tax, Social Security, Medicare. This is the modern ritual of giving a portion of your money to invisible forces, and they expect you to say thank you. But here's the reality. Taxes are the cost of civilization. You pay them, and the government builds roads, funds, schools, makes sure your favorite food truck is not infested with rats, and even sends billion-dollar missiles to places you will never visit. There are different types of taxes. Income tax hits the money you earn. Sales tax hits the money you spend, and capital gains tax hits the money your investments made while you were asleep. Nearly everyone also pays Social Security and Medicare taxes. Social Security is like the government forcing you to save for retirement. You pay now, and you get it back when you retire. Medicare, on the other hand, is a health insurance tax that supports older people or those with serious health issues. Then comes tax filing. Oh yes, the government knows what you owe, but you still have to guess. If you are right, fine. If you are wrong, you are in trouble. Some people pay quarterly, some annually, and then there are those who pay nothing and end up in documentaries. But it's not all bad. Countries with higher taxes generally have a better overall quality of life. Now, banks. You walk in, hand the teller your money. They count it, smile, and tell you it will be added to your account. You walk out thinking, great. Now it's sitting in a vault guarded by a dragon. But in reality, that money is already gone. Most people think of banks as giant safes. In reality, they are middlemen, matchmakers for financial transactions. When you deposit $1,000, the bank takes $900 and lends it to someone buying a jet ski. This system is called fractional reserve banking. They keep only a fraction of the money because not everyone withdraws all at once. Banks make money by lending your money at a higher interest rate than they pay you. You provide the supply, the borrower provides the demand. Banks encourage deposits because it's easier to pay with a card or transfer, and they pay interest as a reward. Plus, in the US, most bank deposits are insured up to $250,000 per person. Interest. Imagine borrowing $1,000 and having to pay back $1,200. Why? Because money charges rent to exist in someone else's hands. Simple interest is a flat fee. Compound interest is every dollar creating clones that also earn interest. Miss a credit card payment, and suddenly a $12 burrito becomes a $50 regret. On the flip side, invest at 7% annual compound interest, and your money multiplies exponentially over time, making you rich if you are patient. Inflation. You buy a bag of chips, open it, and it's half eaten. You paid 30% more than last time. That is inflation. Money slowly losing value. It can be caused by too much money, supply chain issues, or even expectations. A little inflation, around 2% per year, is normal. High inflation erodes savings and wages. Governments fight inflation by raising interest rates, making loans more expensive, and reducing spending. Recessions. A recession is when the economy shrinks for at least 6 months. One day everything is fine, jobs, bills, plans, and the next day, layoffs happen, stocks drop, and everyone saves for necessities. Recessions can be caused by high interest rates, global crises, wars, or simply the economic cycle. They are painful resets, but the economy eventually recovers as spending returns. Credit scores. A credit score is a 3-digit number that decides if lenders trust you. 300 is a red flag. 850 is excellent. It's not about wealth, it's about reliability. Payment history, credit utilization, account age, mix of credit, and recent applications all matter. Take care of it, and it can help you buy a house. Ignore it, and it can ruin your life. currency. Money is not real. It is a social agreement to facilitate trade, organize society, and measure value. A dollar bill has value because people believe it does. Print too much money, and inflation erodes value. Print too little, and nobody can afford necessities. Money is a social construct built on trust. Investing. Investing is making your money work for you. Instead of trading time for money, you trade money for more money. Stocks give tiny ownership slices of companies. Bonds are loans to governments or companies that pay interest. Funds combine multiple stocks and bonds for diversification. Real estate generates rental income. Investing is not luck. It is early, diversified, and patient. The real danger is not investing and letting inflation silently steal your future. Value. Something is worth more because humans assign it value. Steve Jobs created the iPhone, and millions paid thousands for it. Doctors, lawyers, and luxury brands earn much because the market perceives their value as high. Understanding value allows you to create wealth. Time. Time is the most valuable asset. Almost everyone starts with it, but no one has unlimited supply. The richest people have learned to make time work for them. Invested money grows over decades, not days. Compound growth turns small amounts into substantial wealth. In summary, taxes, banks, interest, inflation, recessions, credit, currency, investing, value, and time. These concepts shape the economy and your personal finances. Mastering them allows you not just to survive, but to thrive.